Hello everybody, hope you're all doing very well and as excited as I am for today's lesson video where I am finally going to be covering the theory behind Elliott waves for you all. So whenever I incorporate Elliott waves into my daily technical analysis videos, I always have comments from people asking if I can go over Elliott waves so they can fully understand it, because in my daily technical analysis I obviously use it, but I don't go over into detail the theory of how you can incorporate this into your own trading strategy. So this lesson video is for all of you that would like to understand how to use Elliott waves, because I think it is a great tool. Elliott waves and Fibonacci for me are what makes my trading so successful. It is such a brilliant tool to at least have in your backpack along with everything else. So these lessons, because Elliott waves is such a broad topic, I'm going to have to split it down into 3 or 4 lesson videos, which will go as planned. Lesson number 1, this lesson, is going to be covering the history or introduction of Elliott waves, where you can really understand what Elliott waves are and how they work in the impulse wave. So I'll be covering the impulse waves up or downwards, okay? And at the end of this video, I'm going to give you some really important rules that must be incorporated with Elliott waves. Without these rules, they don't work. So these rules are so amazing. Okay, that will be near the end of this video. Lesson number 2, I plan to cover the corrective waves. So the A, B, C corrections. We'll be going over the corrections. So lesson number 1, covering the impulse. Lesson number 2, covering the corrections. And lesson number 3 and maybe 4, if I don't manage to cover it all in time, 3 to 4 will be examples, and I will be going over so many examples. I'll be going over examples in live trades so we can see live how Elliott waves actually works, where here we could be going like a wave 1, 2, 3. For example, we'll be going over live examples for you all, and I will also be going over history of the like price history of Elliott waves, where we can be getting in our Elliott waves, so you can really see how it actually works, putting the theory to practice. Okay, so the lessons 3 to 4 will be so much practice and seeing how it really works. But I believe you really need to understand a theory before you put that into practice, okay? So that's the plan, and with that said, vamos, let's go. Hope you all enjoy this so much, and as always, any questions about anything, just leave a comment or drop me a message and I will help you the best I can. So let's go, guys and girls, everybody. Let's go straight into this. I'm looking forward to helping you all do this a lot. It took me a long time to finally get this all sorted for you, so let's go. So, introduction to Elliott wave. In the 1920s, there was an accountant named Ralph Nelson Elliott. He looked over 75 years worth of stock data, which led Elliott to discover that stock markets, which at the time were thought to behave in a somewhat chaotic manner, actually didn't. After his discovery, he published his theory in the book entitled The Elliott Wave Principle. And I do recommend you, as I'm reading this, to pick up an actual physical book on Elliott Wave, or look on the internet for the books, because within there you'll have thousands of pages of theory to go through. But I'm hoping to summarize these books, which I have read, within these few lesson videos. So if you like to read a book, you know, go out and buy the book, but I'm hoping to cover the most important things within these videos for you all. So Elliott explained that the upwards and downward swings in price are caused by the collective psychology, and it always showed up in the same repetitive patterns. Okay, he called these upwards and downward swings waves, so that's where we get the name Elliott waves from. His surname Elliott combined with what he found to be the waves, so Elliott waves. Nice to know. He believes that if you can correctly identify the repeating patterns in prices, you can predict where the price will go next. So interesting, though. This is what makes Elliott waves so appealing to traders across all markets. Including cryptocurrency, forex, stocks, commodities, everything where you can have a chart is a brilliant place to be using Elliott waves because of the psychology around traders. It's included in all markets. It's great, a really great tool to understand and use, honestly. So Elliott wave Elliott Waves gives us a way to identify precise points where the price is likely to reverse. And I like to use this always with Fibonacci, and I will be having separate lessons on Fibonacci retracement and extension because that is my favorite tool, and really they go to work together so well. So essentially, Elliott came up with a system that enables traders to catch tops and bottoms. So I personally love to use Elliott Waves with Fibonacci extension and retracements, as I mentioned, because they go together like bread and butter. Honestly, the two together just work amazingly. Using them on their own is okay, but together they just form the partnership for good trades. So I will, be covering the Fibonacci extension and retracement in another video. I love Fibonacci. I love it so much. But this one is Elliott Wave. So let's continue. So the first five waves in a pattern is called the impulse waves. So where were we looking earlier? So these 5 waves, 1, 2, 3, 4, 5, these are called the impulse waves, okay? So they're the impulse. One of the 3 impulse waves, 1, 3, or 5, will always be extended, meaning one of those waves will be longer and bigger. And this is usually, like very, very often, the wave 3. So wave 3 was most of the time, the majority of the time, going to be the biggest wave, okay? The second 3-wave pattern is called a corrective wave. Letters A, B, and C are used instead of numbers to track the correction. Where here we got our correction, so after the up or downwards, you got the A, B, C correction. Okay. Waves 1, 3, and 5 are made up of 5 smaller impulse waves, while waves 2 and 4 are made up of 3 smaller corrective patterns. Okay, so this is all to do with factuals of everything is subdivided into itself. So here you would have 1, 2, 3, 4, 5. Here you would have 1, 2, 3. Here you'd have 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. So you have Elliott waves within Elliott waves within Elliott waves within Elliott waves within Elliott waves reoccurring, okay? Depending on obviously the time frame you're looking at. It's so interesting. So there are actually 21 types of corrective patterns, but they are made up of 3 very simple and easy to understand formations, and the 3 fundamental corrective patterns are zigzags, flats, and triangles. So there's 21 in total, but you can put these 21 patterns under 3 main headers of zigzags, flats, and triangles, and that's what I'll be going over in the next lesson video for you all. Okay. So it's important to understand this, that factuals are, I hope I'm pronouncing this okay, factuals, sorry, my pronunciation is not great here. Factuals are structures that can be split into parts, each of which is a very similar copy of the whole. Mathematicians like to call this property self-similarity. Okay. So one important quality, or what really important to know this, that Elliott waves, they are made up of factuals, okay? So much like seashells and snowflakes, how they are all the same, essentially, Elliott waves can also be further subdivided into smaller Elliott waves, as I just mentioned. So Mr. Elliott showed that a trending market moves in what he calls a 5-3 wave pattern, where you have your 5 waves up or down, followed by the 3-wave correction. Okay, so the first 5 waves are called the impulse waves, and the last 3 are called the corrective waves, and we obviously have 21 corrections. Elliott waves can work in a market trending upwards or downwards, so you can use this either way, where you have your impulse waves up, as here, or the impulse waves down. So you can use this to help you find short and long targets, selling or buying. It's great. So Elliott waves within an Elliott wave. Okay, so Elliott waves within the Elliott waves. As you can see here, the 5 and the 3, they are all subdivided up by more Elliott waves, and this is because remember. So this is why you get the subwaves within the Elliott waves, because they all follow this cycle. Okay, so you have the grand super cycle, which for looking at as Bitcoin as an indicator, we can obviously there is not centuries of price data, so we can use, for an example, the monthly chart. So the monthly chart we can call the grand super cycle, okay, where within here we could actually still be only forming from the wave 1, 2, and now we still might be forming wave 3, which say goes to like 30,000, and then wave 4 back down, and then wave 5. Okay, so like that. So your grand super cycle, then the super cycle, which could be classed as like the weekly, and then the cycle, which would be classed as the daily, and then the primary, 12-hour, intermediate, 4-hour, etc., etc. So you have the primary, intermediate, minor, minute, and sub-minute. Okay, so it's important to understand that every overall Elliott wave has the another Elliott wave within it, and that's why you can even use this on like the 1-minute chart. And then obviously on the 1-minute chart, you're doing your 5 Elliott waves. You zoom out to the 5-minute, and you have another set of 5 Elliott waves. You zoom out to the hour, and so on and so forth. You understand? So a grand super cycle. So yeah, this is essentially just explaining each below Elliott wave is made up of the higher Elliott waves. Okay, so with that said, now we're going to be focusing, that's kind of the introduction to Elliott waves, and now we're going to be covering the 5 impulse waves and how they work. Okay, so wave number 1, so here you can replace stock with commodity, stock with forex, stock with cryptocurrency. It's all essentially the same. Okay, so the stock or cryptocurrency makes its initial move upwards on wave 1. So wave 1, let's zoom back out here. Here. So wave 1, we make our initial move upwards. This is usually caused by a relatively small number of people that all of a sudden feel that the price of the coin is so cheap, it's a perfect time to buy. And obviously, if this was reversed and then it's becoming a value too high, then you get it back down. Here I'm going to be covering it over the theory as if it's the 5 wave upwards, but remember this happens downwards as well. Okay. So for instance here, this is classed as a perfect time to buy. The stock or crypto is considered very low, and that's what causes the first wave upwards. Okay, so wave number 2. At this point, enough people who were in the original wave who bought the bottom consider the coin or stock overvalued, and they begin to take profits. This causes the coin to go down. However, the coin will not make it to its previous lows before the coin is considered a bargain again. So you see here, number 2, so that we got the wave 1 up, and then this is where people that bought down here want to start taking profits. Always people take profits in any trading. It's a necessity. Okay, so people take their profits, but you'll never see the wave number 2 going down below where it started. Okay, normally you could expect like a halfway retracement, and that's when other people that didn't get in at the bottom of wave 0 here, that saw it shoot up in price, are now thinking, oh, I want to get in on this. So it would normally say you'd get like a 50% retracement, and this is where you use your Fibonacci retracement to try and get a price point in. But yeah, this is another video that I'm excited to bring you. So then once the wave number 2 has made its way down, this is then when you get the third wave. So this wave number 3 is so often, like really often, the longest and strongest wave. The coin has caught the attention of the mass public. So this is as if we're looking on a cycle, so for instance like on a daily or weekly chart. Okay, so it's caught the attention of the mass public. More people find out about the coin and want to buy it. This causes the coin's price to go higher and higher. Okay, so you get the initial wave up, people take profits, and you move down. And then when it stops and starts to consolidate, and then it starts moving back up, so people are seeing when it's breaking the wave 1 resistance here, and it's starting to make a very strong impulse wave up on wave 3. This is where you get a lot of people buying in, and this is why wave 3 is like normally the biggest wave, because this is where it's gaining a lot of attention. Okay, so it's all to do with psychology. So yeah, that's not, wave 3 is normally the biggest for that reason. Wave 4, traders take profits because the coin is considered expensive again. So you got a very big move up here. Let's say you had like a 120% move up, for example, and then the coin is considered very expensive again, and people are thinking, oh, I don't want to buy in that high. This is very expensive. Again, people taking profits, and with the supply and demand, obviously supply and demand is a very big thing. A lot of people are taking profits, and not many people are wanting to buy it after such a big move upwards. Okay, so wave 4 tends to be weak because there are still the people in there that are bullish on the coin and are waiting to buy the dip. So after 120% move upwards, when the coin starts to move down, say 30%, Then there are people ready waiting for their coins. Maybe they took profits at the top, or other traders are waiting to buy the dip. Okay, that's buy the dip is when the coin moves down in price and they're ready waiting with their orders. Okay, and then that obviously causes the start of wave 5. So wave 5, traders and investors start coming up with ridiculous reasons to buy the coin and will try and ridicule you if you disagree with them. You get this all the time on social media like Twitter, and it's just crazy, where people will really try and shill you this coin so hard, and they will give you like ludicrous reasons to buy the coin, and they will really argue and put up arguments if you try and disagree with them on this coin. It's crazy. You see this all the time, especially on Twitter. It's crazy. So this is when the coin becomes the most overpriced. Okay, so the top of wave 5, when you start getting all these shillers really pushing this coin in your face, this is when the coin is overpriced. Okay, so contrarians start shorting the coin, which starts the ABC pattern. When everybody's eyes are on the coin, when everybody is fearful, that's when you buy. So when the coin's very low and everybody's selling, you buy. When everybody is talking about the coin and it's everywhere, that's a good time to sell. Okay, it's just how the market works. So that's the best time to short, when you see like people's grandparents asking about the coin and wanting to buy in, for example. So that brings us to the 3 rules that are always followed on Elliott Wave. So these 3 rules cannot be broken, and if they are broken, then it means you have incorrectly counted your waves and you must do a recount. Okay, so the 3 rules that can never be broken on Elliott Waves. Rule number 1. This is very important, so make sure you make a note of this yourself because it's so important. Rule number 1. Wave 3 can never be the shortest impulse wave. So wave 3 can never be the shortest wave. This, for instance, if we were looking like this, and wave 3, let's say it was like this, and wave 3 is the shortest, this is not a valid count. Wave 3 cannot be the shortest, okay? So that's rule number 1. Wave 3 is the majority of the time the biggest wave, but it can never be the shortest, okay? Wave number 2 can never go beyond the start of wave 1. So wave 2 here can never go beyond the start of wave 1. So this is this would not be a valid count. Okay, so wave 2 would normally see a sort of 50% retracement, but it can never go beyond the start of wave 1. That is would not be a valid count, and you would have to recount your impulse wave. Okay, or look at it, maybe you're in a correction, etc, etc. So wave 2 can never go beyond the start of wave 1. And rule number 3, wave 4 can never cross into the same price area as wave 1. For cryptocurrency trading, I allow a wick at most. Okay, this is because we are playing in a highly leveraged market. There's people playing with like times 100 leverage. It's just like a really crazy, really volatile market. Obviously, you don't get such volatility on things like stocks, especially big stocks, whereas in cryptocurrency is renowned for its volatility. So that's why I allow a wick, but I wouldn't allow a close of a candle. Okay, so that's basically saying wave 4 can never cross wave 1 like this. Okay, so wave 4 can bounce. It should always be using this as support. If wave 4 goes down to here, for example, and closes there, the candle closes, this is not a valid impulse wave, and you would have to redo your count. Okay, so wave 4 must hold wave 1 territory. So I hope that makes sense. That's why it's a very good idea to be playing your buys on this support. It works out so well. Okay, so those are the 3 rules that must be abided by. Okay, these rules are the bread and butter for Elliott Waves. They must be met. Okay, so these are guidelines that can be broken, but I find they work very well. So these rules can be broken, but the majority of the time I find them working, and they really work as a trader. Okay, so sometimes wave 5 does not move beyond the end of the wave 3, and this is called a truncation. Okay, so this is where we are seeing wave truncation. So wave 3, wave 5 here. Oh, may need to move to the right tool. Yep, so wave 5 can sometimes go like this, okay? Where wave 5 does not move beyond the end of wave 3, and this is called a truncation. So it's normal to see what like a 5 waves like this. So you get 1, 2, 3, 4, and the 5 ending on par with wave 3. And then you could have what is known as a double top resistance. You get your double top where wave 3 and wave 5 created the double top, and then you obviously get your ABC correction. And a 3-5 double top like this is then creating a heavy resistance, okay? And you would expect quite a bearish correction after a double top like that. And that's how you get the double top from a 3-5 impulse wave failure of the wave 5 not going above, okay? So yeah, that's truncation. Wave 3 tends to be a very long, sharp and extended wave. This is because of everybody buying in. So it would be normal to see the third Elliott wave to be a very sharp extended wave like that, where you then get your retracement and wave 5 to move on. But wave 3 is normally the sharpest, so a very quick and quick impulse wave up, okay? So that's explaining that. Wave 3 is normally a very sharp and extended wave. Waves 2 and 4 frequently bounce off Fibonacci retracement levels. Always keep an eye on the 0.618 golden ratio level for Fibonacci. That's a ratio, so when wave 4 and wave 2 are coming down, I would take my Fibonacci retracement from the start of the wave to the bottom and try and be buying in on a nice like Fibonacci retracement level. But I'm going to be covering this again in another lesson. And finally, use Fibonacci extension to find price targets for wave 3 and 5, and I would for standard be targeting between 1 and 2,618, okay? And that essentially just means taking your Fibonacci extension and using it like this, and from here you can get your price targets for wave 3 and wave 5, where you'd hope to see your extension targets being met like that, okay? So that covers the theory behind Elliott waves, okay? So this lesson was much of an introduction so you can understand the Elliott waves. Next lesson I'll be going into detail of the corrective waves, so you understand the theory behind the corrections. And the final lesson, or final 2 lessons, because I do want to give you so much examples so you can really put the theory into practice, is really going to be looking at charts. So lessons 3 to 4 are going to be looking at several different charts, okay, where we are going to be going over a lot of examples. So I hope this lesson was helpful for you. I realize I've been speaking a long time here. I hope it wasn't too boring, my voice for you as we were going through this, but yeah, I love teaching, and I understand totally I need to improve as a teacher. So give me time, and I promise with my lessons I will be really trying to put in a lot. When I start something, I want to do my best in it. So I'm going to be trying to improve these lessons with videos with every time I do a lesson, okay? So bear with me, please. But yeah, I'm doing this all for you in my free time to help you guys out. So there you go. Hope it was very helpful. As always, leave me any comments or anything you'd like to say in the comments below, and I'll be responding and keeping in touch with you. I hope this was helpful, and I will see you in the next lesson where we'll be covering corrective patterns. Okay, thank you so much for watching, and make sure, if you are not, subscribe so you don't miss any of my future videos. And if you feel kind, and give me a follow on my other social medias of Twitter and Instagram. I'm regularly posting updates about my life and trades. So thank you again for watching, and I'll see you in the next video. Peace. Cheers.